Hi everyone, thank you for tuning in to Conversations with Lawyers, Investment Funds Edition. My name is Damien and together with me is Ian. Today we are very privileged to have with us a special guest, Mr. Leonard Ng, to share some insights pertaining to the investment funds industry.
Mr. Leonard, allow me to briefly introduce you to the viewers. Mr. Leonard is a partner at Sidley Austin London, where he heads the UK and EU Financial Services Regulatory Group. He advises a wide range of global financial institutions on complex UK and EU financial services regulatory issues. Particularly, Mr. Leonard specializes in advising clients on regulatory matters relating to investment funds, which will be the primary focus of our interview today. Perhaps Mr. Leonard would like to tell us more about his experience in this industry.
Great, thank you. It's nice to meet both of you, Damien, and you don't have to call me Mr. Leonard. Leonard's fine. Yeah, a bit of context. I was an NUS law student a million years ago, and ended up working for my firm. It's the only firm I've ever worked for in London, and I've been doing that for 23 years. And for most of the last, I guess, 15 years or so, or even more than that, maybe almost 20 years, I've been focusing on regulatory matters, and for many of those years in the investment fund sector. So as the investment fund sector has developed, especially on the alternative side, hedge funds, private equity funds, along with some of the normal standardized institutional funds, the world's become much more complex. And the regulatory landscape, the way the investors deal with the sponsors and asset managers has changed dramatically over time. And I think the current environment we're in, which is unfortunately a pandemic, actually highlights some of those issues. We're facing some of the similar issues we saw with the last financial crisis, 2008, 2010, which I lived through, and I had to advise a lot of asset managers at that time. And we're seeing some of the same market stresses this time. And of course, whenever there's market stress, the regulators also take a great interest, because at the end of the day, there are set aside retail investors. There are also very big pension funds, endowments, which are invested in various investment funds. And at the end of the day, it's mostly about investor protection and making sure that people don't effectively get their life savings frittered away by someone doing some bad thing.
Right, thank you, Mr. Leonard. So I'm sure his depth of experience in this industry will lend special insights to his perspectives on the pandemic and its impact on investment funds today. So perhaps Damien could continue on with this point.
All right, today we'll be covering two broad issues, namely how investment funds have been affected by the COVID-19 pandemic and Brexit situation, respectively. So, Mr. Leonard, we hear a lot about the new normal, with the work from home phenomenon as one of its most defining features. Are there any legal or regulatory implications that fund managers should take into account when working from home?
Yeah, sure. I mean, there are a bunch of different things to think about. So, for example, if people are working from home, and I'll use my context. So I'm based in London, and as you know, London is like Singapore and Hong Kong, an asset management center, a financial center, and a lot of the talent that lives here or that works for UK-based firms are actually international in nature. Many of them are French, German, US, and so on and so forth. And since in the UK we had a lockdown starting in early March, and from that time, it became quite normal for people to, well, in fact, required for people to work from home for several months. And some of the, let's say, portfolio managers would be working from their homes in Sweden, in France, in Spain, and so on. And I think that raises all kinds of interesting issues. So set aside, the fact that then you may be causing your firm. So if you're a portfolio manager and you're working from your, let's say, family home in Sweden, you might be causing your firm from the UK to have set up a place of business in Sweden. And that has different implications. For example, do you need to have set up effectively a local branch of your UK asset management firm in Sweden, in my example? Do you need to apply to the Swedish Financial Services Authority for permission and authorization to carry on that activity there? Do you have to set aside your personal tax circumstances? Do you cause your firm to have established what we call a permanent establishment from a tax perspective in Sweden? So these are the sorts of things that have been raised. And I think initially when people were working from their homes, people by and large we felt comfortable that was okay. But as time drags on and you get past, for example, the 6-month mark, that's when certainly tax and regulatory lawyers like myself start getting a little bit nervous as to what you might call literally the permanent establishment of a firm there. So that's one aspect of it. Another aspect of it is, how do you monitor your staff? I mean, you've got very, asset managers, of course, subject to all kinds of conduct of business obligations, compliance obligations. They have to make sure that, they comply with firm policies. There are market abuse or insider trading risks. There are general compliance risks. There are, personal account trading risks. By personal account trading, it means, of course, if you're an asset manager, you shouldn't be trading for your own personal account, your own book, because that puts you in a position of a conflict of interest with your fund or indeed your firm and the investors. So that's a big issue. And if you allow people to work from home for extended period of time, there are implications of monitoring. So can the legal and compliance team of the firm properly monitor people from afar? I think most firms would say that they've done it okay, but they're nonetheless, the fact of the matter is when people are left to their own devices, there's always a nervousness that they may go off on a frolic of their own, as we say, and cause problems with the firm. And of course, there are other things like confidentiality, cybersecurity. If you work from home and you have a housemate or a flatmate who works for a different financial institution, in fact, we had one situation relatively recently where, we were advising one asset manager whose analyst was sharing a flat with a different asset manager's analyst, and they were actually working on the same deal. It turns out they were both firms were interested in a particular, I think it was a distressed asset. And how do you have Zoom calls with your colleagues, with your flatmate, within earshot? That raises confidentiality restrictions, breaches, market abuse issues, and so on. And then I think finally, when you think about government mandates and work from home mandates, at some point, of course, the lockdown starts to get lifted, and that's been the case, I think, in Singapore as well as in the UK. Although in the UK, as you may have seen, we've closed down a little bit again. But the point is that when various countries and governments start to open up, and that's true of much of Europe for the time being, you start to have the question of what do people do when they go back? Are they required to go back? Is there some implicit pressure from the management team to go back? If you go back, how do you deal with health and safety issues? For example, have you taken steps to make sure your office environment is a safe environment? What about data privacy? As I think Europe has the strictest, we think, data privacy laws globally. And for example, if you require someone to specify that they do not have a fever, or for that matter, if they have some kind of personal health issue which might make them particularly susceptible, for example, if you have an autoimmune disease, you disclose that, and how do you disclose that? How is that information protected for the individual? So there are all kinds of employment law, data privacy issues that can arise in this kind of environment.
Right, thank you, Mr. Leonard. So as you've mentioned, I think right now there are many multinational firms who employ staff of various nationalities, and we see staff working from various locations. So in that sense, would you say that this entire work from home phenomenon has really caused more inconvenience than convenience on the side of investment funds?
I think apart from the issues I mentioned, to be honest with you, I think most firms would say they have managed to handle it properly. Of course, like with any other business, working from home has certain challenges. Of course, you're not able to make contacts. For example, if you're doing diligence, if you're doing an acquisition, doing diligence on the company, it's, most of the time it's virtual anyway, but sometimes there's no substitute for having, face-to-face meetings with the management team. There's no substitute for making site visits. And some of those things, of course, are restricted, but that's true of, I think, any industry right now.
All right, thank you, Mr. Leonard. So moving on to the economic side of things, we understand that the current market conditions are rather unstable. So is there a regulatory framework in place to deal with such market volatility?
Well, yes and no. I mean, yes, in the sense that, as I said, when we had the last financial crisis, again, taking the European standpoint, there was a new financial services framework in the EU. in Europe and the EU. And there were about 40 plus separate European Union directives dealing with effectively post-crisis issues. So everything from financial stability, regulatory capital for banks, short selling rules, new rules regarding asset management, new rules regarding brokerage and trading. All those things were put in place at the last crisis. Of course, we're now facing a new crisis. What was a health crisis has, as you know, become to a certain extent a pretty serious financial crisis in its own way. Not exactly the same way as at that time, because the companies so far, and touch wood, so far are still relatively healthy, at least in certain sectors. The financial sector is relatively healthy. Of course, others have not fared so well. But in terms of that, I think what we've seen so far is certain steps taken by regulators, at least in Europe, to deal with potential instability. So for example, between April and July, I think it was June or July, the European Securities and Markets Authority implemented certain bans on short sales or short selling. They also tightened the rules on short selling, so you have to disclose a net short position effectively more quickly than you would have, because they lowered the threshold for that. They've started thinking about, and of course, at the central bank level, there were various asset purchase programs, to support, buying bonds from companies. They're trying to focus on things like liquidity management, risk management, and liquidity management being a serious one, because you had certain investment funds which had relatively illiquid assets, but which were otherwise meant to be liquid or open-ended. So for example, a property type of fund, it's not the right time to be doing a fire sale of anything. So those sorts of issues are being focused on. And I think finally, one of the things that certainly ESMA, the European Securities and Markets Authority, has done is to think about leverage caps for alternative investment funds. So and indeed fees and performance fees. There are many things which regulators are doing right now, but it's just not got the same kind of structural issue that we did in the last financial crisis. I think the last thing that the regulators are doing in Europe is really to try and reduce the regulatory burden. So for example, they have reduced or rather lengthened timelines for certain reporting. So, recognizing that many firms are not in their usual place of business, having difficulties in gathering data, certain reporting obligations have been pushed back, certain second order financial services regulatory initiatives have also been pushed back or delayed to a certain extent. So that's helped, and I think it has also reduced the obligation under some of these directives. So there are a whole bunch of different things going on at the same time.
Right, thanks Leonard for sharing about the regulatory aspect of things. So maybe we can talk a little bit about the investment side of things. No doubt, generally investors have become more risk averse in the light of such market volatility, but as I understand it as well, there are also investors who may seek to hop onto this bandwagon and leverage on this market volatility to make certain profits as well. So Mr. Leonard, what kinds of funds have suffered or possibly even benefited from the pandemic itself?
Yeah, I mean, and this is actually a good time to talk about the fact, of course, that the investment funds industry is really, really diverse. I mean, you have everything from pure, highly liquid retail funds that only invest in highly liquid, for example, listed equities, all the way to infrastructure funds, or certain private equity funds which only hold illiquid assets for which you may not get your money back for 5-10 years. So it's an incredibly diverse industry, and I think depending on where you sit within the industry, you could have different opportunities or threats. I mean, what we saw with our clients, early on in the pandemic, the lockdown, probably about March, April, there was a huge amount of activity among some of our private equity clients because they spotted an opportunity to, basically look at assets and go, well, we think there's a real dislocation in pricing, so we're going to go in there and try and buy up the asset. One of the interesting things you saw, however, was that, sticking with that private equity theme for a second, is that some private equity firms were actually doing things which, as far as they were concerned, was absolutely correct. I mean, raising getting the right asset for their clients. But some PE firms, are set up really to just buy, let's say, mid-market, small, medium-sized companies. But some firms will also go into buying the distressed debt of these companies in order to effectively become the major or controlling creditor of the firm. And it's what we call loan to own in the private equity industry. And it's interesting because some PE funds can do that, but the question is, are their investors expecting them to do that? It's a different question. So thinking aloud about how funds should be structured in this pandemic is perhaps to make sure that you've got the flexibility to do what you need to do in your document. You don't want your investors to say to you, hang on, we gave you all this money to simply go and buy shares in X type of sector. Why are you buying distressed debt? We're not taking that kind of risk. It's a different profile of risk. So that's an interesting thing. But we did see a lot of opportunities for some of those funds early on in the pandemic. Those opportunities, I think, have softened a little bit right now as things try to stabilize. But as we all know, it's entirely possible we go into sort of not a V-shaped recovery, but a W-shaped recovery. And if we have another big drop, there could be another opportunity there. I think second point would be a lot of our distressed credit funds. So on the credit fund cycle, still more, if you like, on the illiquid side, there's a lot of activity simply because firms are starting to get into distress and their bonds are starting to trade at 20 cents on the dollar. At the same time, a lot of distressed funds were making direct loans. So one of the features of investment funds these days, compared with 30 years ago, is that you can make direct loans, so direct lending funds. And sometimes you will do emergency financing to distressed companies. And so again, at the start of the pandemic, there was a lot of opportunities for that. Again, of course, right now, because of government support, and so if you bear in mind timing, right? So back in March, when things started to go really choppy and go south for a lot of companies, there were a lot of opportunities, but then governments all stepped in and basically supported all the companies and the economy with furlough schemes and stuff like that. And so, for example, you haven't seen a huge wave of bankruptcies, but I think people are expecting that at some point, the money will run out. And if we're still in this kind of economic scenario, we will end up with even greater opportunities for those sorts of funds. I mean, unfortunately for the companies, but fortunately for those types of funds. Then again, moving on, some of our other clients suffered pretty badly because they were heavily invested in certain asset classes that have really suffered. So the oil sector, airlines, hospitality and leisure. And then, of course, I also have some clients who made a lot of money out of that period because they shorted those exact same companies. It took, right at the start of the pandemic, when I remember this back in February, when I think it was February when Donald Trump, for example, banned flights from China to the United States. That was already the signal for some firms that they should short the oil and airline industry. And so some funds hedge funds basically did very, very well out of that, while others who took a contrarian bet and decided, no, this is a short-term type of pandemic, made certain losses. Moving on, if you think about the fact that closed-ended or illiquid funds probably did okay because they weren't subject to redemptions from investors, right? So if I'm an investor and I'm nervous about current economic climate, I'll try and get out of the fund. And if I'm in a very liquid, open-ended fund, I will simply redeem, and take my money back and put my cash under my pillow, my mattress. But and that's bad for the asset manager, of course. But if you're in a fund with a lockup, 5-10 years, then of course that's more stability for you. And also, I think moving on from there, you also got different types of funds, such as I mentioned, sort of open-ended funds which invested in illiquid assets like property, which then had to put up gates or restrict redemptions, which regulators really don't like because and in fact, that's one of the problems. Regulators will say, you set up this fund to be apparently liquid to allow redemptions within a certain cycle, whether it's 30 days, 60 days, 90 days, and all of a sudden you put up a gate. If these are retail funds, I think you have a problem in your hands. Regulators really don't like that. If this is an institutional fund, so institutional investors, I think that's a little bit better. Maybe final 2 points. One is that, we saw out of the pandemic, funds that were algorithmic or quantitative in nature, systematic trading funds. And a lot of these funds work on computer models and algorithms. And the data that they use, of course, is historical data. And so in a time of normal market conditions, the quantitative type firms would be able to assess data on a pretty consistent basis. And they will make their calls, and some make money and some lose money. But in a situation where you have a sudden market disruption, or what you might even call a black swan event, then of course the data gets very, very skewed. And so some of the quant funds which were not able to adjust, I think suffered a little bit as well. A final point, actually, is that one thing we did notice out of this last 6 months in terms of investment funds is actually a bigger focus on the ESG sector, environmental, social governance. So there are a lot of investors, especially in Europe, who have historically, for many years now, had a real focus on investing in the right way. In other words, investing in funds that, as far as they're concerned, meet certain ESG criteria, or at least they want to know that the manager, the sponsor, is thoughtful about sustainability risks, about the material adverse impact of their investment decision and strategy on all these factors. And the interesting thing is that based on market data, it looks as though the ESG funds actually did relatively okay. In other words, they seem not to have been as badly affected by the market conditions. And the other thing that's happened, of course, is that thinking about the pandemic and thinking about things like healthcare, things like a social, if you like, net for people, disadvantaged people, has made a lot of people think about the social aspect, the S part of ESG. So you've got a lot of funds now which are focused on, social bonds, for example. Green bonds on the climate side have been pretty popular because of the climate, change issue. People focusing on the fact that, a pandemic is what you might call a low probability but high risk type of scenario. And then extrapolating that to, we should be investing in things like, funds which are thoughtful about climate change. So for example, climate change is probably a higher probability and high risk. So climate change, green bonds, social bonds, that whole sector has really, I don't want to say exploded, but has certainly seen a lot of interest. And in Europe, that's also maybe coincidentally because we now have a brand new ESG regulatory framework to support all those activities. So I've been rambling for a while, but that's a whole range of, as you can see, the fund sector is extremely diverse and there's a whole range of different things you can do.
Right. Thanks, Leonard, for sharing about the ESG funds, especially. I thought that was pretty interesting. So would you say that COVID itself has become an impetus for investors to move towards ESG funds? Do you think that this is a sustainable trend of behavior and that COVID has resulted in this kind of a paradigm shift in the behavior of investors when in terms of selecting the funds that they want to invest in?
I don't know if it's a paradigm shift. I mean, we certainly have clients who tell us that the investor base, again, depending on which part of the world you're in, but in Europe especially, a lot of European investors, especially Nordic investors, have been very focused on ESG. And I think they would have been focused on ESG even without the pandemic. But I think the pandemic makes people realize that these sorts of factors, the sort of social good governance, social responsibility, maybe less the green side as far as pandemic is concerned, but even the green side comes about because as we know, or at least scientists are talking about the fact that one of the reasons for these sorts of pandemics is because of deforestation, because of too much building into forested land, and then some of the wild animals end up in our food chain, so to speak. So I think it's a combination of all those things, and I think the sector has certainly taken a lot of interest from investors, new investors, not just those that have historically been interested.
All right, thank you, Leonard. So as the saying goes, with great power comes great responsibility. Now with great crisis comes great risk. So Leonard, you have mentioned a little bit about the heightened risk that have resulted from the pandemic itself. So could you also share with us how do funds generally deal with such risk?
Well, I mean, we talked about making sure that your documents are, properly set up so that you have some flexibility. You're not just tied to just buying shares of certain companies. You can't buy their debt. And sometimes what you want to do is buy the debt and then control the company and effectively end up owning the company, right? Converting the debt to equity. So you've got to have some flexibility. The other thing that, thinking about counterparty risk, because of course, if you're facing other counterparties or financial institutions that are going to be badly affected by the pandemic, then you need to make sure you've got enough diversification. So for example, this is, funnily enough, this is actually less of an issue than it was in the last crisis. So in the last crisis, you know, I was there on the morning that Lehman Brothers went down, and that basically set up a chain of events, right? Because Lehman was such a big player. I mean, I was also there when Northern Rock went down, but that's a relatively, you know, local UK-based bank. When someone like Lehman Brothers goes down, the entire financial system is hit. Other financial institutions which were exposed to Lehman then got into trouble. So that sort of exponential effect, if you like, I don't think we've seen that this time round. So for example, in the last crisis, if you're an investment fund and you were facing certain brokers or custodians, you would make sure that you now had multiple prime brokers, for example. If you're a hedge fund and you historically had one prime broker, out of that last crisis, very few hedge funds today only have one prime broker. They've got 3, 4, even 5, depending on how big you are and how you want to diversify your concentration risk. I think that is a little bit less relevant this time. People seem to be set up properly for that. So I think it's mostly about making sure you've got the right diversification in your investment strategy and identifying, you know, frankly, being a better investor. So I don't think that it's not the same as we had the last time around this time.
Thanks, Leonard, for your insights on how COVID-19 has impacted investment funds. So actually, there's a more peculiar point that is specific to the UK. As we all know, the UK has the Brexit phenomenon. So you think that the UK has been dealt with a double whammy in terms of Brexit, and has Brexit further impacted investment funds negatively?
Well, you know, it's interesting because on the one hand, Brexit, of course, has been, the vote was in 2016. So we're 4 years in, 4 plus years in, incredibly. And one would say that they are, you know, disconnected. Brexit and COVID are disconnected. But actually, I think there is some knock-on effect because there are probably 2 things worth thinking about. You know, first of all, the pandemic just makes it harder for negotiations to take place. You know, there are physical meetings, but many meetings have to be, you know, as we are doing right now, on Zoom and these sorts of virtual conversations, which are, let's be honest, a little bit less effective than an in-person meeting when you're negotiating something as serious as the future of your country's economy. So I think that will have reduced the perhaps trust factor between the 2 sides. It will have slowed things down at a time when we don't really have time to slow things down because, you know, we have a deadline, which is the end of this year. And, you know, this deadline at the end of the year was set in something called the UK-EU withdrawal agreement, which of course was entered into before the pandemic, right? So people had thought, yeah, there's enough time for us to discuss a trade agreement, to think about financial services equivalents and all those things, but it's just not happened. So we're moving towards what is possibly a double whammy, where the economy is unstable because of a pandemic, and at the same time will become even more unstable if we do not have a financial services deal. Now, if you think of, and just trying to bring it to the investment funds discussion, because of course that's what we're talking about today, I think the key point is that actually for investment funds, Brexit is, depending on the kind of fund you are, an issue or not so much an issue. I mean, it would be an issue if you were a UK-based manager that had a lot of European clients, that had a lot of European retail investors, and you were relying on something that is called the single market passport. So by that I mean that within the EU, if you're a fund manager in, you know, country A, let's say in France, you would be able to manage assets across the continent, across the EU, in fact, the whole European Economic Area. You would be able to market your funds across the whole EEA. And of course, the UK, while it was part of the EU, could do that as well. But that passport is now lost or will be lost from the end of the year. And so if you're, especially as I said, a retail fund or a fund that relied on this marketing passport to raise capital, you will lose that unless you establish something on the continent. Now, many firms did not, especially on the retail side, they did set up their own, you know, operations in Luxembourg and Dublin. Ireland and Luxembourg are the 2 main countries for investment funds in Europe, although France is trying to increase its presence in that sector as well. But of course, the pandemic has made it harder because, you know, what what the EU regulators are saying and constantly saying is, dear UK financial services firms, we are now very close to the end of the year, and you need to actually move people here. But in a pandemic, no one wants to move, right? So that's another area where I think the pandemic has had a negative impact on business operations, because simply getting on a plane. So the idea for some firms was that some of their staff would actually just fly back and forth, at least some of the senior staff, right? Because the senior staff are probably responsible for a range of things, and you don't necessarily want them to be in one place. So the idea, for example, would be, I'll just hop into Eurostar and go to Paris, and every other day. We can't do that. Or you could, but you quarantine. There are certain exemptions for working staff, that work on both sides, and they don't have to quarantine. But all this is very, very complex. Trying to move large numbers of people to a new base in Germany, for example, not practical. No longer are you allowed to just fly back and forth. So I think that's a real issue. Now, as far as some other investment funds go, so for example, if you're a hedge fund or private equity fund on the alternative side, Brexit is probably less relevant for you, which is why, interestingly, if you were monitoring the whole Brexit discussion, there were some very prominent hedge fund founders in the UK which were pro-Brexit, whereas some were anti-Brexit. And there's a whole range of reasons why people vote or didn't vote for Brexit. People have their own reasons, and that's absolutely fine. I think those that were pro-Brexit probably felt that for their firms, they weren't really going to be impacted. So if you think about the typical investment fund structure on sort of the hedge or alternative side or private equity side, you might have a UK-based sponsor or manager. Your fund is likely to be in, Cayman Islands or Jersey or Guernsey, any of the offshore jurisdictions. And the result of having your fund in an offshore jurisdiction is that you can't use this EU marketing passport that I mentioned earlier on anyway. The marketing passport is only available to an EU-based manager with an EU-based fund. So for example, if I were, prior to Brexit, if I were a UK-based manager and I was the manager of a Luxembourg or an Irish fund, I could market that fund, throughout the EU on the basis of that marketing passport. Whereas, now I don't, now I can't. But if I had a Cayman fund or Jersey fund or Guernsey fund, I could never have used that marketing passport anyway. So Brexit becomes relatively academic for me, right? So you have that dynamic. But then you also have the third scenario, which is there are a lot of international managers, mostly from the United States, but also a couple from Singapore that I know, and Hong Kong, who have set up an office in the UK. Now, this UK office is not the manager. If you think about the fact that from a legal perspective, the investment management firm might have been established in Singapore, let's say. If they set up an office in the UK, they will typically not set up a branch, which is the same legal entity from a legal perspective as the Singapore entity. They will actually set up a UK subsidiary or an affiliate, right? It's a separate legal entity from a corporate perspective. And if you do that, then and you say to your UK entity, hey, we're in Singapore, we want to raise capital from European investors. Can you, the UK entity, our affiliate, help us do that? So you hire a marketing and investor relations person in your UK office, and you want that person to go around Europe, marketing your fund for you. Now, there are, of course, certain rules on marketing, which are in a certain European directive called the Alternative Investment Fund Managers Directive. But a key point here actually is that the UK entity doesn't really have the right anymore to go around Europe marketing products. So to give you an example, if you're a Singapore-based manager and you wanted to raise capital from 3 or 4 countries in Europe, what you would do under that Alternative Investment Fund Managers Directive, or AIFMD, is that you go to the local countries, the 3 or 4 countries, and you apply for the ability to market the fund there. And so let's suppose you went to the Dutch regulator and said, I would like to market my fund in the Netherlands. The Dutch regulator basically says, okay, actually it's just a notification, which means, of course, that the Singapore manager can now send its people to the Netherlands or have calls with Dutch investors and raise capital. That's all fine. But if the Singapore manager were to then call its UK affiliate to do that, well, the UK affiliate is not the actual manager. The UK affiliate is no different from any third-party placement agent. And it wouldn't have the ability to go around Europe doing those things because that's a regulated activity in some countries. So on the investment fund sector, that's kind of where you end up. Different types of funds have different types of considerations.
All right, thank you, Mr. Leonard, for your insightful sharings and perspectives on the impact of COVID-19 and Brexit on investment funds. So, all right, today we've come to the end of today's episode on Conversations with Lawyers. So do remember to like this video and subscribe to our channel for more bite-sized legal content pertaining to this pandemic. So goodbye and see you again.
Thank you. It's been a pleasure.
Thank you.
Thank
Thank you,
you.
Mr. Leonard.